Welcome to another edition of Capital Conversations. I'm Colin Day, certified financial planner professional, and with me today is Sophia Steinbecker. Sophie,
Hello.
Thanks for joining us.
Thanks for having me.
Sophie is newer to the firm. She's been here for about 7 months now.
7 months, yeah.
She's our front desk associate, and she also assists me with doing a lot of the podcast stuff. So I took her from behind the camera and forced her to sit down in front of the camera today, and we are going to have a cordial, fun conversation about being new to the workforce and learning a little bit about finances. Because Sophie, you graduated from the College of Charleston.
Yes.
Your degree was in?
Business admin.
Business admin. So
Yep.
She's doing administration for us, so obviously this is a natural fit. But in this role, this is the first time you've worked in financial services.
Yes.
Okay. So if you had to think about your experiences with finance previous to this job, what was your background before sitting down in our front desk over here?
So with my major, I think I had a couple finance classes, but just kind of the basics, I would say. And then I do have a credit card.
Okay.
And I mean, that's pretty much the extent of my financial background.
Okay.
I would say.
I mean, did you have the finance class that you took, anything to do with personal finance, or was it more just corporate finance?
It was more corporate finance. I will say I did take a personal finance class, I think junior year of high school.
Okay.
But I can't say I remember a lot from that class.
Okay. Well.
Unfortunately.
Well, I'll say this: I know what school you went to. We don't get into high schools. Although this is a St. Louis area podcast, maybe, which is a notorious question. If you're not from the St. Louis area, you probably don't know the joke there. But we won't talk about what high school you went to. But I do commend your high school for at least offering a class on financial planning or just personal finance, because that is something that is sorely lacking.
Yes.
And I think just sitting here, you probably learn a lot of stuff.
I do.
That maybe you didn't even learn there.
Yes, lots.
Good.
Lots.
All right. Well, good, because that's part of your job is to, in your career development, that we start to think about, hey, what are some other things that interest Sophie, right?
Yes. Yes.
So, if so to lead off this podcast, the whole reason that Sophie is on this side is obviously to introduce the audience to somebody that you might be talking to. If you're a client or thinking about kicking the tires on Correct Capital, Sophie's our frontline woman, so to speak, and so she does a lot from the marketing perspective, but also she helps with a lot of the administration of the office. But as a newly minted professional, this is the first foray into financial services. I wanted to have Sophie on because she's got questions. And I consider myself a professional.
Yes.
A certified financial planner professional, maybe. And what we wanted to do today is maybe get some of the questions that has been on her mind, out of her mind, and onto paper, so that we can talk about them and we can learn a little bit, right?
Yes.
Yeah.
Lots of questions.
Did you have any trouble creating questions for me?
No.
No.
Because I have a lot of questions, and they go far beyond this list.
Okay. Well, and I told her it was like, let's start with 3, and then we'll work off from there. I think we'll have a total of 4 questions. There's a bonus question. That's number 4.
Yes.
But let's start with question number 1, and we'll work our way down. So why don't you read the prompt that you gave me?
All right. So my first question is, what are some tips on budgeting and saving as I'm just beginning my career?
Yeah, and it's pretty common. So it just so happens that yesterday I was out of the office. I was 2 hours west of here doing some 401k education. And there was a theme. And it just seemed that everybody I was talking to was 1 or 2 years out of college.
Okay.
And many of those folks were in some kind of engineering profession, let's say, and they make pretty good money. And they're just looking for answers to some of their outstanding questions.
Right.
Because while they can be great savers, the biggest question I hear is, where does the next dollar go? So when you think about your paycheck, when that paycheck hits your account twice a month, do you personally, do anything with that? Do you say, hey, okay, well I'm going to pay myself first. I'm going to put this money over into this savings account, and then I'm going to pay off my credit card, and then I'm going to put this aside for my rent check. Are you going through that process?
A little bit. I'm not great at it yet, but I think the first thing that is in my mind is saving. I put some money to save away, and kudos to my mom. She was the one that initially told me to start doing that. And then I would say the second biggest expense is rent. Yeah. That's where my mind goes, making sure I have enough money for that. That's money set aside. And I guess bills and things like that.
Right, yeah.
Yes.
Those are also important, so that you have like electricity
and
internet and stuff. Yeah, okay, I got it. And your dog has food to eat and other things.
Yes.
Toast, her lovely, you call it a pug, or what do you
French
call it?
Bulldog.
French Bulldog. Oh
Yes.
gosh, I'm sorry. I degraded
okay.
I degraded Toast. I'm sorry. we want to make sure that everything is taken care of.
Yes.
So, what I had written down here, the first thing that we start off with everybody is making sure that we have some kind of emergency fund. And so, regardless of what account that's in, we just need to make sure that we're saving enough so that when the next expense comes down the pike, that we have the funds available for that emergency. So for example, we might say, as a single income household, so to speak, we would suggest 6 months of your expenses in cash. So if you can think about how much you spend on a monthly basis, we want to build that up to 6 months.
Okay.
And that could be quite a sizable sum, right?
Yeah.
And the reason is because, again, you're never going to leave us. But if for whatever reason you did, and you were out of work for a time, maybe you say, hey, Colin, I need to take some time off, and I just want to be out of the office for 3 to 6 months or something like that. We need to make sure that we have those expenses taken care of for you. And the easiest way to handle that is in some kind of cash account of some sort.
Okay.
So for some folks, that's the checking account where all of your cash sits,
Okay.
and then sometimes it's a savings account.
Okay.
So do you have 2 different bank accounts? Do you have like a checking and a savings?
I do.
Okay. Do you know what your savings rate is on that account?
Ooh, I don't think I know.
Okay. Something to look into tonight to see, hey, what am I earning on this account?
Okay.
Because depending on where you're banking, there might be a more lucrative option for you.
Okay.
Because if you're just sitting on a bunch of cash doing absolutely nothing, you're actually losing money against inflation.
Right.
Because all the goods and services, toast, dog food is going up.
Yes.
Unfortunately, you're just not producing enough income off of that. And so that's why it's important that we are productive with that money still.
Okay.
Okay. So from a savings perspective, it's a 3 to 6 months.
Okay.
After we have some savings built up, maybe it's not all the way up to that 6-month mark, but we feel comfortable, that's when we start to attack things like where you're incentivized to put money. And that's like your 401k.
Okay.
That's probably the best example of that.
Okay.
Same thing with like a health savings account if that was available to you.
Okay.
So if your employer is providing some kind of match on those dollars, that's the next logical place, because if I put money in, my employer is also giving me money on the side too.
Right.
And then the third thing that I just written down here is more of a just a general guidance, are credit cards. So you've already told me
Yes.
that you have a credit card, right?
I do.
And I think you told me you think you have cash back on that card.
Yes.
Okay. Would you happen to know if you get like different percentages depending on what you buy with that money?
I think food might be
So
a
like
higher
grocery stores or
yes, a higher
restaurants?
percentage of compared to other things, but I don't know the specifics,
Okay.
unfortunately. I'm sorry.
Well, and if you have a family going forward, you'll understand that, hey, there's the card that's for the grocery store, and then there's the card for gas, and then there might even be a third card for everything else.
Yes.
It just depends on how thick your wallet is, really. And as somebody who just keeps their wallet in their front pocket, I only have a couple cards. But there is intention behind those things.
Yes.
So pay off your credit card every single month. So I don't think I needed to tell you that, but I will say it. You don't carry a balance on your credit card if you can help it, because it does not improve your credit score to carry a balance. So I have talked to many people over my career that say, I just keep a little bit of a balance, Colin, to keep the credit cards and the credit industry happy. And we say, that's a big time out there. Stop doing that.
Okay.
Carrying a zero balance is very important because it shows that you're able to pay off the entire thing.
Right.
So the credit bureaus will appreciate that.
Okay.
Okay. So from a savings perspective, again, building the emergency fund, making sure we have cash, making sure we're productive with that savings cash, and then also attacking what is available to us from a matching perspective from my employer, where am I incentivized to put money, and then making sure that we're making smart decisions as we use our credit card every month.
Okay. Got it.
All right. Have I floated your brain too much already?
I don't think so.
Okay, because
Let's
we got at least 3
I
more
know.
left. Why don't we read number 2?
All right. So number 2, what is the best way I can contribute to my 401k, and when should I start contributing?
Yeah. So newly eligible, right?
Yes.
For the
Yep.
401k plan, so congratulations.
Thank you.
Depending on who you are watching or listening to this podcast, you may or may not be eligible for your 401k. Every 401k is different. So you might have to work for 3 months or 6 months or maybe even a year. Maybe you're 19 years old and the plan doesn't let you in until 21. So everybody's going to be a little bit different in this regard. But to answer the question, when should I start contributing? Well, we would encourage you to do it as soon as you're able to.
Okay.
Get the safety net first.
Okay.
So get the savings in place first, because with a 401k plan, there's a lot of restrictions on how you can use those funds. Because with many of the people that I was chatting with yesterday, it was, hey, yeah, you're eligible for your 401k plan, but you also just told me that you have significant debt. You've got a pretty big credit card debt. Maybe you've got only $500 in the bank account, period. I'm not talking savings, I'm just talking period. And that makes me very nervous for you to put money into an account, like a retirement account, which is designed for, guess what? retirement.
Right, yeah.
It's not designed to dip into all the time, and not every plan allows you to dip in all the time.
Okay.
So that's why we say start with the emergencies fund, get that safety net build up, and then we can look at the 401k.
Okay.
Okay, and then from in terms of what is the best way to contribute to my 401k? Well, there's likely two different ways to contribute. There's pre-tax and there's Roth dollars. There's probably not enough time in this podcast to go over why one might be more favorable than the other, but pre-tax contributions, which is more of what literally is called traditional contributions, that is the way where we're paying the taxes later when we withdraw those funds. So I get the money in, I'm not paying taxes on it, I'll pay on them later when I'm in retirement likely.
Okay.
Roth contribution is, I'm going to pay taxes now. So
Okay.
because I think it makes sense for me to pay the taxes now so I don't have to pay them later, because I think in my career I'm going to make buku bucks, I'm going to become CEO of Correct Capital or what have you in the future. I'm going to make a lot more money, so I'm in a lower tax bracket now. I'd rather pay the taxes currently.
Okay.
It also allows that money to grow on a tax-deferred basis. So what that means is that you're not paying taxes on all that money as it grows, and then the IRS is so thankful that you paid your taxes up front that they'll forgive you on the back end for paying taxes on those earnings. So
Okay.
fast forward 30, 40, well in this case 40 years in the future for you, when you're thinking about retirement, that whole bucket of money in theory should be tax-free,
Okay.
which is pretty lucrative for folks. So for many younger people, Roth makes more sense than pre-tax.
Okay.
But if you have a significant other and you're jointly filing on your taxes and that person's making $400,000 a year, pump the brakes, because now we're in a different tax situation just from what you're making within your role. So it's a balancing act between the two.
Okay.
So to put it more plainly, once you have your savings built up, then we feel like we can attack the 401k and take advantage of the free money.
Okay.
And then from your contribution resource, you're likely incentivized to do more Roth than pre-tax contributions. One last thing I'll mention here is that matching dollars from your employer are normally pre-tax.
Okay.
Probably 99.9% of all 401k plans, any kind of matching dollars, profit sharing dollars are on a pre-tax basis. So you
Okay.
will have to pay taxes on those.
Okay.
And the reason I say 99.9 now is because now in 2024, plans are able to offer Roth contributions on the employer match. So you could
Okay.
actually say, hey, Correct Capital, that money you're putting in, I'd like that to be Roth or after-tax dollars.
Okay.
Okay? It's not yet available even on our plan.
Okay.
I'm pushing for it.
Okay.
But it is something that's going to come about and might be available to you in other career opportunities.
Okay.
Okay?
All right.
All right, so that was best way I can contribute to my 401k, and when should I start contributing? What's question number 3?
All right. Question number 3. What would you say the priorities in my life should be being so early in my career? And what are the top things I should be paying attention to or aware of?
Yeah, so obviously I'm not you, and everybody is a unique snowflake, right?
Yes.
So when it comes to making decisions about what matters most to you, I mean, ultimately your priorities come first.
Right.
As a financial advisor, I'm listening to our clients to figure out what their priorities are, and then making a decision after that. So when it comes to you, if you are a blank slate, I take the dry erase eraser and erase the entire board. What I would encourage you to do is, you're in your early 20s, right? Most of the stuff that we attempt to do is build good habits, right? And a lot of the stuff is super boring. It's building the emergency fund, it's putting the money in the 401k, it's not racking up credit card debt. It's kind of the basic stuff.
Right.
And I know I'm active on social media. You might be as well.
Yes.
You might have heard of an app called TikTok or Instagram
Yes.
Reels, and there's certainly some good follows, let's say, but then there are definitely some bad ones. And so when I say boring stuff, it's not some of the stuff that you see out there.
Right.
Because we don't want you to be thinking about this one video is talking about purchasing real estate, or you'll get rich over time by buying this one insurance product. We want to ignore those types of things.
Okay.
Is your algorithm running you into those types of videos, or is that just me?
I maybe get one in a blue moon.
Okay, well, lucky you.
Yeah.
When you post a lot of content focused on finances, I guess I just get a lot more of that too.
Yeah.
I mean, this is outside of maybe the questions that you put here, but in terms of big things that you want to do, like in the next 2 to 3 years, I mean that could be buying a house. I know I think you just bought a new car. Maybe it's just
Yes.
paying down the car.
Yes.
Are there big things that you want to do in the next couple of years that might be a priority for you?
I don't think I would like to buy a house
Okay.
in the near future, but the car is a big one. That was my first big purchase, so paying off the car was a big, that was one of my other bills that I would say next to rent is paying the car bill. But not really that are in my head, right off the top of my head, but no.
Well, and if that's the case, it's interesting because I'm, again, as a financial advisor, I'm interested where next dollar goes for you. And we talked about basic savings, we talked about 401k, but then the next logical thing is, okay, well, do I think about other kinds of accounts? Do I think about other kinds of savings? Again, more boring stuff. So we're not talking about doing esoteric, weird strategies. We're talking like you're going to open up a Roth IRA. You're going to open up a brokerage account. But one of the things I would encourage you to do is that even though you're not a financial advisor and you're not giving advice, of course, but one of the things I would encourage you to do is maybe try to do some of this on your own. So for example, I got a lot of value in opening up an account for myself, putting the money into an account, and then figuring out the investment. Okay. And of course, you've got a whole office here, right?
Yes.
Can you double check my work, please?
Yes.
But I find there's incredible value for those people that have done the work. And I think maybe this predates you maybe by just a couple of years, but when GameStop was going off their stock, and AMC and all those meme stocks were going nuts.
Yes.
Well, the worst thing that happened is that people lost money. But I think the best thing that happened to most people that did that was that they learned a lot about the stock market. They learned how to perform, how to choose things, how to make decisions. And they probably learned a lot of valuable lessons, let's be honest here, as opposed to positive ones.
Yeah.
But they did learn a lot. Have you been thinking about opening up anything yourself besides like the 401k?
Oh, not really.
Okay.
I know some friends that have some accounts, but I feel like I don't know enough yet to think that far in advance.
Well, that's okay. And again, the nice thing is for someone like yourself is that you've got, guardrail, so to speak, in the form of, shooting ideas by me or Brian or anybody else, or talking to the portfolio managers. And you don't have to get complicated with this. I'm, of course, not saying, hey, go buy one particular stock or something like that. You can just purchase a very broad market index mutual fund or ETF. You can keep it very simple. Just I think the process of just opening up the account, you're going to have to think about things like beneficiaries, which is pretty weird when you're in your early 20s, right?
Yes.
But it's a reality that we have to think about, like, oh wow, who do I want this money to go to?
Yeah.
What family member is going to receive this, or who's important in my life that I want to make sure I take care of, with my last expenses. So it starts to creep open some doors that are a little dark on the other side, but it does start to make you think a little bit more about adulting, or however you want to put that.
Yeah.
Right.
Right.
So again, trying new things I think is really important. And you said that you weren't ready for certain things, but I think a lot of people that are in their early 20s probably feel the same, right?
Yes.
So I have a question for you. So this is bonus questions. This is question number 4. So from a career development perspective, and what you've learned working here for the past 7 months, you've heard a lot of conversations. You sit in marketing meetings, you sit in our team meetings, you overhear conversations, you hear client calls, and you have to route them to the right people, understanding what we all do that's different in the firm. What do you think you could teach other people in your age bracket as they're starting to build their earnings and savings journeys?
Well, I'd say the big thing that I've learned is lots of terminology. Like, if I hear someone on the phone and I hear a certain word, sometimes I'll wander into Colin's office and ask, what's a Roth IRA?
You do.
And I do. Just curious. So I think that I can pass along some of that information to my friends. And I think I've learned a lot just from everybody in the office, just little random things, because I'm curious, and I don't think I learned that much in my finance classes in college that that was that useful. We were doing lots of equations and things like that I don't use here, but I think it's been really beneficial to me to just overhear the conversations in the office, and I've learned a lot. And I've gotten really good at asking questions because, if I hear a conversation, I don't understand something, it's sometimes fun to learn about something that I'm not familiar with, or I mean, I've tried to ask my parents, certain questions. What's a 401k was a big one for me before I came in, that I tried to ask my parents. They weren't too great at explaining that to me.
Yeah.
But
Well, I'll say this. So I've been doing this for a while now, and I've been out of college for too long. And my first job, when I was starting off being a contractor for a 401k call center, I got my big boy 401k,
Yep.
and my first phone call was to my mom. And my mom is the one that told me about what I should do in my 401k. Mind you, what was I doing professionally? I was talking to people on the phone about their 401k plans, and I still went to my mom. So there is absolutely no shame in, I think, anybody doing it, because over time you can learn a hell of a lot of good things by just asking good questions and reading. There was a term, we talked about actually in the other podcast we just recorded, like the Magnificent Seven. I did not know who the Magnificent Seven stocks were until 2 days ago. So there are things that, it's like, oh, that terminology has been around for a couple of years now, Colin. It was like, new to me.
Yeah.
Like, there are things, there are new products that come out, new, technologies that, result in new equations to determine your financial health or whatever it is. We're always learning. So
Yes.
even those people that are frustrated, or even if yourself, you feel frustrated that you're at the ground level of knowledge and you're trying to build, the first story, so to speak, it's important to continue to struggle through it, learn, come out a lot better on the other side by continuing to pursue that.
Yes.
So, Sophie, thank you for being candid. Thank you for being a guinea pig, so to speak, in this kind of format with your questions. You learn anything? You learn anything good?
Yes. I'm got lots of notes to take and things to put into action.
Okay, good. Well,
Yep.
I'm just down the hallway when you have questions. So.
You know that I always wander down there and have questions.
Yes.
All the time.
All right.
So.
Well, that's fine. That's what we're here for, right?
Yes.
Okay.
Yep.
Everyone, thank you so much for joining us for another edition of Capital Conversations. If you found this value, we hope that you like and subscribe and all that good stuff for us. And if you have questions, to reach out to us directly. So on behalf of Sophie, I'm Colin Day. Thank you again, and we will chat soon. Take care.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Correct Capital Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Correct Capital Wealth Management and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Correct Capital Wealth Management unless a client service agreement is in place.